Good afternoon and welcome to today's Premium Account short form market update for the 12th of February. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, current Managing Director of Investor Signals and Global Equity Management and the Investment Manager for the Investor Signals Unit Trust. I have 17 years of experience in the financial services industry and a current licensed securities and derivatives advisor. The format for today's presentation is a short form market update, so it's a quick summary of the macro update. We look at stocks within the ASX Top 50 that have reported earnings over the course of the last week and some of the names to focus on in the days ahead. We tie that in with our recent transactions on both our internal account and client accounts and conclude with a short-term market outlook. The services that we provide are up on screen there, and if you'd like to know more about those, please contact myself, Leon, at investorsignals.com. Up on screen is a graph of the Dow Jones. Now, US December quarter earnings are more than halfway through at the moment, and based on the same time last year, earnings are up around 7.5%, almost 8%. If we look at sort of where we are at from a forward valuation standpoint, that puts the US on about 15 times forward earnings, allowing for somewhere around sort of that ongoing run rate around 7 or 8% into 2014. We think that sort of generally the central bank's liquidity provision and focus on equity markets and trying to drive a recovery in asset prices in general, both from a property perspective and from a equity or share market perspective, I think continues to underpin. We look for improving growth data out of the Eurozone over the next 6 months, and in the back half of the year we expect to see sort of more of a synchronised global GDP picture that maybe accelerates corporate earnings. From a bond perspective in the US, we've seen yields on the 10-year fall from 3% back down to 2.5%. We're looking for it to track sideways within this range of 2.5% to 3%, and I think that provides a supportive backdrop for equity markets and feeds into our base case that equities have a period of consolidation. When we look at the Australian market, which we're just commencing our earnings season now, we're tracking at around 14.5, 15 times forward earnings. We're probably looking at somewhere more in the order of 5 to 7% earnings growth for the Australian market, well supported by yield. And again, we think that we get a period of consolidation followed by the high probability in the back half of the year that we have synchronised global growth and therefore a greater level of optimism for forward earnings growth, and we'd expect to see that started to be priced in the form of further PE expansion as we get into an improving earnings outlook over the next 12 to 24 months. At an individual company level, let's just have a quick look at where we've seen earnings results. So on the case of Fox, we saw slightly disappointing numbers there where the market was looking for about 10% EPS growth. They came in marginally below that, so I'm expecting Fox to track sideways at around this $35 level. We've seen the banks deliver their results in ANZ and CBA. ANZ's result was very pleasing. CBA really just met market expectations and reaffirmed their dividend guidance. In the case of Computershare, probably been the standout performance so far in the earnings season, and probably on the other side that's disappointed, a standout has been Cochlear. In the case of Computershare, the earnings exceeded probably expectations somewhere in the order of 10%. The underlying business on a forward outlook we think will continue to deliver around 10% EPS growth. It is trading on a high PE and on a reasonably compressed dividend yield, so even in light of today's good earnings result, still maintain that we'll probably see a period of consolidation in Computershare. CSL, good top-line revenue growth. They had a one-off expense that related to a legal settlement that's impacted profit. The company's still continuing with their $900 million share buyback on a forward outlook, looking for the stock to be trading around 21 times earnings on a 10% EPS growth. We own it at lower levels. We've sold the $71 calls into the middle of the year. I think we're sort of sitting at the right level there on CSL. Stocklands has been one of our preferred property exposures here in Australia. Their earnings result came out in line with expectation. The dividend's been reaffirmed, so the stock's sitting, if anything, the result was marginally ahead of market expectations. But the stock's sitting on roughly a 6% dividend yield. We own it at lower levels. Where we own it from previous levels, we managed to sell the $4.20 calls. Where we own it back here in the stock rally, we sold the $4.20 calls. for new money that's flowed into Stockland's at or near this levels, and we've been adding to the Stockland exposure over the last 3 or 4 days, so we picked it up sort of at lower price levels. Again, on a move back up to around $3.90 to $4, I think that's full value. I don't think it supports a yield compression much below 5.5%. So again, we look to sell those $4.20 calls there, driving in excess of 10% cash flow out of Stocklands. WRT ex-dividend roughly around 10 cents. Stock tracking at around 5.5–6% dividend yield, not looking for too much in the way of earnings there, but comfortable with our position there in WRT, looking to sell the covered calls European style out at the end of the year around the 3.20 level, so we collect the current dividend and again collect the dividend in the back half of the year as well. Starting tomorrow, we've got a couple of names of note that report earnings results tomorrow. In the case of ASX, looking for a dividend yield confirmed at around 89 cents, and the first half profit will come in around 190 million, which is only up marginal on last year. So our base case on ASX, as you would know from previous recordings, is that we're really looking for earnings just to simply move sideways, and it's a dividend yield, and if we can complement sort of that 5% dividend yield with another 5 or 6% premium through the covered call strategy, we're driving around 10% cash flow, and we're pretty comfortable that the downside risks are minimal in the ASX as a good defensive cash contributor to portfolios. Also reporting tomorrow in the property space, we've got Goodman Group. We don't own this. Our preference has been GPT. Goodman Group should deliver around 6 to 7% earnings growth. I think on a 5% dividend yield, the stock's well supported. GPT's been our preference, and I think this is partly attributed to the slightly higher growth rate, looking for around 7% EPS growth here out of GPT, and the share buyback that the company's doing. So I think it continues to sort of underpin the stock. At around 380, we look to sell the covered calls after owning it at lower levels. Also tomorrow we have Rio. We generally don't own Rio in client portfolios. Our preference has been BHP and Woodside Petroleum. The chances of seeing any news out on special dividends probably a little bit too early. I still think we're seeing a focus from management of paying down debts and reducing gearing levels. Transurban tomorrow, stock tracking at around sort of 4.5% dividend yield. It doesn't pay its div again until June, so probably the stock pushes higher into that sort of April-May period, and that may provide an opportunity for us to sell the covered calls out into the back half of the year. Telstra also reports tomorrow, looking for around sort of low single-digit earnings growth here, and there's a minimum confirmation of the 14-cent dividend yield. The market had been pricing in the possibility of the dividend yield being pushed up to around 15 cents a share, so we'll wait to see what the commentary out of the company is on that tomorrow. And then what else we have? Newcrest reporting on Friday, so we've seen better performance here out of Newcrest, largely off the back of a slightly stronger gold price and better production numbers. They're starting to track back up towards 2.5 million ounces a year. Probably a little bit of short covering here as well that's helped push the price higher in Newcrest. AZJ, this is one of the names that we've been adding to just on this recent sell-off. We've been buyers of the stock down here at around 480. Up at around 525 is our target. AZJ reports its earnings results on the 17th, looking for those numbers to deliver double-digit earnings growth and reaffirm our position there that around 480, 475 is probably good value. 525, the stock starts to get a little bit expensive for our liking. A couple of the names reporting next week, we have Wesfarmers, Asiano, Amcor, BHP, Coca-Cola, and Brambles are probably some of the names next week of note. Just to conclude in today's short form recording, I'll just have a quick look at some of the transactions that we've been active in over the course of the last week. So Brambles, we're buyers of Brambles down here at around 870. The strategy here is to let the stock run up to around 890, and then we'll look to sell the covered calls up at around 925. We collect the upcoming 14-cent dividend, so that by the time you strip that back out of the price and we were to get a recovery back up to our call under either option, whether we just simply collect the call premium, collect the dividend, and drive that in excess of 10% cash flow, or we end up delivering the stock under the call in that sort of June period where we'll deliver in excess of 20% return on investment. I think Brambles is well-supported investment. It has high exposure to US dollar earnings, so if the Aussie dollar does fall at the margin, it will help underpin Brambles. But the underlying business should deliver around 5 to 8% earnings growth and a little bit of added return there through the currency move, the favourable currency movement. Maybe we get to 10% EPS growth, and I think that sort of underpins the Brambles story going forward. ASX, as I mentioned earlier, we've been buyers of that sort of at around this sort of $34.50, $34.70 level, and looking for it to trade higher into the upcoming dividend, and then we'll look to sell the covered calls over that. Westpac Bank, we were buyers of that around the $30.50 level. In general, the banking sector starting to compress back down to a low 5% dividend yield again. I think that's where it'll find consolidation. In that case, we'll look to sell calls over Westpac up at around sort of this 33.50 level. They'll be European style into the mid part of the year where we'll collect the upcoming May dividend. AZJ I've already spoken about. Telstra we've covered. ANZ's been another one that we've been recent buyers of down here. So as with Westpac, looking for it to push marginally higher, and then we'll look to get the calls away there. Santos, within the oil and gas space, so Santos we've been buyers of this at around this sort of 13.50 level, looking for it to push back up to around 14.50. Not looking for too much in the way of earnings growth here in Santos. I think the story here is the possibility of the company increasing their dividend payout. I don't have the earnings results coming through for Santos until the 21st, so we've still got a week or so to wait there for the results to come through on Santos. Origin, again, not looking for much in the way of earnings growth at around $15. The stock's compressing down to a low 3% dividend yield. I think it runs into resistance. But these oil and gas stocks in general, I think we're coming into a period where they start to perform well, and likewise just touching on Oil Search there as well. Good production numbers out of Oil Search and with Origin, and I think it sort of continues to underpin sort of a bit more of an optimistic outlook around these oil and gas plays. Also, just from a recent transaction standpoint, we've been buyers of Toll on this pullback at $5.50. We look to sell the calls up at around $6. The stock's on about a 5% dividend yield and maybe some earnings growth somewhere in the order of around 3%. Toll, as far as their earnings results, might have to come back to you next week on that one, but I don't think they're coming up soon. So Toll, around the 19th of February, they deliver their earnings results. And then finally, just on the derivative side, in the last week, we've been reasonably quiet on sort of getting the covered calls away, but one of the names that we've capped is Woolworths. After owning it at lower levels, we've seen their confirmation of their earnings guidance come out where the business is likely to deliver somewhere around 6% EPS growth. I think that sort of supports the stock at around this 34.50 level, probably not too much beyond that. So at around 35.50 we've sold the covered calls. We've collected around 90 cents for those, and we'll collect the upcoming March dividend as well. And that's really sort of sums up the recent transactions over the last week. I'll just conclude today's short-form webinar with a quick look at the market and a reminder of sort of what our base case is for equity. So we're looking at the US market here at the moment. As we move into the conclusion of the December quarter earnings in the US, we start to focus a lot more on Australian earnings season over the next week or two. The Australian market, the expectation is that we get through earnings season and we see confirmation that at a general level, the XJA is growing earnings somewhere around 5 to 7%. We think that the early part of earnings season, albeit only a few days into it, we're not sort of seeing any reason to question that forward guidance. So I think our base case is reaffirmed that equity markets are well supported on the buy side, probably given the PE expansion that we've had, get into a period of consolidation, and then we look for sort of further share price expansion in the second half of this year. Thank you for listening in, and I look forward to speaking again next week.